Welcome to EBW's first 2017 webinar. It is with great pleasure to introduce Ted Cox and Elizabeth Dooley, who will be presenting the 2017 Economic and Market Update. So let's go ahead and begin by first introducing both Elizabeth and Ted. So let me start with Ted. Ted holds the Charter Financial Analyst and Financial Planner designations. He's Managing Director, Senior Investment Consulting. He joined the former Rockdale Investment Management, predecessor to City National Rockdale in 2001, and has over 25 years of diversified financial investment industry. He is responsible for business development throughout the Mid-Atlantic region, where he communicates and fosters relationships with high net worth investors who may benefit from the City National Rockdale's investment management. And Elizabeth Dooley also holds the Charter Financial Analyst and Charter Alternative Investment Analyst designation. She is also Managing Director and Senior Portfolio Manager, and Elizabeth joined the former Rockdale Investment Management, predecessor to City National Rockdale, in 2000. She works closely with advisors to develop customized portfolios based on the client's investment objectives, time horizon, income needs, and tolerance for market volatility. In this role, she is responsible for the investment strategy, implementation, and monitoring of private client portfolios. And with that, I will go ahead and turn this over to Ted so that he can begin our economic and market update. Ted?
Thank you, Carmen, and thank you for the introduction, and we certainly welcome the opportunity to speak to everybody today. There's obviously a lot going on in the economy and in our world and the news feeds and however we get to the news. So we want to just take this time to maybe put some perspective on things, talk about the economy and how that relates to investing. So the first page we're going to look at is a summary where we're thinking that the economy looks to be on a positive track. Consumers are still the primary driver of our economy, and the consumers are fairly healthy. And we'll have some slides to look at that later on. Jobs are pretty good. The housing sector is pretty good. We expect the Fed will raise rates in March, but to a modest degree, and that will not have a big effect on our economy. In fact, as we've said for a long time, it's a good thing if we get back to a fairly healthy Fed rate without depressing the Fed rates. If we look at the bottom chart, there's an interesting dynamic here where we see GDP growth of, we think, 2 to 2.5% in 2017. But then look at the corporate profit growth, where we think we're going to have a good bump in that corporate profit, and that is going to come from maybe some tax relief coming from the Trump administration as well as some regulation relief. So a lot of what we're saying is that the economy is on a good trajectory at this point. There could be another bump coming if we do get that tax relief. So that's something to look for. There are obviously implications from that, which we're going to discuss here in a little bit, but that's really an important indicator of how this year will go. So let's go to the next page, if we can. So we like to just say positives and negatives. So as I was saying before, positives, tax reform, tax cuts, fiscal stimulus. If there is infrastructure building, whether it's a wall or fixing dams or bridges, that is stimulative to our economy, and then some regulatory relief. The negatives is kind of what we're seeing now. A lot of disorder and chaos, which creates some uncertainty not only in the populace, but then in the investing world as well. So we're starting to see that, and that worries us a bit. Trade protection. We do not want a trade war with China or Mexico or anything like that. That is detrimental to our economy. And then also just the risk of the geopolitical risk can also erode uncertainty in our economy. So those are some things to worry about and think about. So let's do the next page. Just as a look back on last year, we know if we look at the top three lines there, so oil has been volatile, but oil had a good run. But then the next two lines, the Dow Jones Dividend Index, so those are stocks that are paying high dividends, plus the S&P 600, the small cap, did very well. So that just to put it in perspective as to where we were last year, and how can we build upon that for this year. We continue to look at interest rates and how that affects bond yields. So if we look at the bottom of this chart, a lot of those categories are in the bond category just due to the lower interest rates. Let's go to the next page. For those of you who we have talked to before, this page will be familiar. It's called our speedometers or windshield wipers, and it's a good way to put it all into perspective as to what's going on in the world. This page changes at least once a month. It's trying to look forward to say, where do we see the economy going in the next 3 to 6 months? What are some pitfalls? What are some opportunities? And it just creates a good dialogue. So as I was explaining before, on the top left, monetary policy is still very accommodative. We have low interest rates, lower than normal. That means that for those who want to borrow money, there is money to be borrowed. The banks are starting to let up some of their funds, so that's a good thing. In mortgages, that's obviously been a huge lag a while ago, but that is starting to come around, and we're seeing that geographically, meaning all the country, housing and mortgages, generally housing is healthy. The market will have further detail on this, but for the most part, we're getting close to full employment. There certainly still is underemployment, but when we have full employment, it starts to impact wages, which means then there's an impact. We'll go 3 over and 2 down: consumer spending, consumer sentiment, that sort of thing. Again, we'll have another chart on it. The consumer point is as healthy, you could say as wealthy, as they've been in a long time. The consumer has more money to spend on discretionary goods, meaning they're spending less of their paycheck on housing and car payments and school loans and things like that. So that's a good thing. That creates a good dynamic within our economy. On the bottom right, we worry about the geopolitical risks, the political environment. Again, if any of you have seen this chart before, sometimes we put those as red. So political environment definitely could be red. But it's really our way of saying the yellow is there because so far the political daily tweets have not had a huge impact on our economy and on the business environment. Obviously, we're seeing the stock market rolling. Earnings have been good, and we continue to see the economy doing fairly well throughout the year. Let's go to the next page. So one of the things we're looking at, which I talked about before, is tax relief. So on the top is where we see the Trump plan. If you look at the far right of the top chart, we think that the highest marginal rate will come down. The low rate will stay about the same, but that highest marginal rate going down to 33% will have an impact on spending for those in that tax bracket. But the real impact is on the bottom. If you look at the far left, that's the United States corporate tax rate, which is the highest of most countries or groups. And so you can see the GOP House proposal, which would bring that tax rate down to 20%. and then the Trump proposal is 15%. Either of those would have a significant impact on corporate earnings and on profitability, and would be sort of that added boost that we're looking for in the stock market at this point. However, well, I'll get to the however here in a second. The next page, there you go. There's an interesting dynamic, and if you look back at previous tax cuts, many of them were done when we were in the middle or coming right out of a recession where there was slack in the economy. So a tax break would have a huge impact, a leveraged impact on the economy. Well, at this point where we're at a very good employment scene, inflation is low, it will have less of an impact than it could have. So that's just something to think about. We still welcome the tax break. However, it may not have the desired impact that other tax breaks have had. So that's really what we're talking about when we look at the tax breaks of 81, 86, and 2000, 2001. Those are really right in the dips of an economy where there was a very good way to get a steep rise out of the economy. We don't see that steep rise really happening this time. And then, of course, we go to the next page, the long-term impact of cutting taxes means that without a increase in revenue from other sources, then who's going to pay for it? And so we see mounting deficits and debt. And so obviously, you know, when we look at these things, you put a straight line on stuff that's not quite correct. You can say that increased economic activity will increase tax rolls, and that's fine. But just kind of looking at the straight line impact, it starts to be daunting as to how much debt could be accumulated over time. So those are the long-term impacts of any short-term benefits that we might see. Let's go to the next page. And let's skip that page. So tailwinds, headwinds is still kind of like a positive, negative. Again, we think the U.S. economy is resilient. The U.S. consumer remains the key driver of our economy. There's an issue globally in that with a strong dollar relative to other currencies that hurt our exports. However, we think as long as the employment situation stays the same and the Fed is very cautious about raising rates at the right time, we think that our economy should remain on a stable footing. We do also worry about, again, trade wars and any sort of tariffs and things like that. That we feel just theoretically is detrimental to our economy. Let's do the next page. We try and keep score, and it's an inaccurate science, but what's the likelihood of a recession? Recession and stock market dip don't always go hand in hand. One sometimes comes before the other. And so later on, Elizabeth will talk about, you know, equities and when they might have a correction. But as far as the economy goes, we see that there's less than a 30% chance, kind of in the 25% chance of recession. We don't see any bubbles. We don't see any corrections happening. We don't see any imbalances in the economy. So looking at history, what has caused recessions before, we just don't see any of those indicators happening in the next 12 months. Let's do the next page. So one thing we're always looking at is where is the potential for growth? And so over the last 3 or 4 years, there's been a downturn in industrial production in our country, even while personal income and business sales have gone up. So we would look to that as a rebound, and that will also have a nice impact on our economy if we can get that declining red line to really start to turn and really have a bottom where it is now. So that's something to look for. Can we increase industrial production? And you know, if you listen to some of the Trump talks, there is an added emphasis on getting that industrial base back up and running. So that's an interesting thing to think about. Let's do the next page. And then when we look at the consumer and cyclical spending, there's also a way to go here to get back to the norm, the dotted line. So we have the U.S. cyclical spending can improve, and there's room to improve. So there's a little bit of slack, as I was talking about before there. So that's a nice thing to think about there. And let's skip the next page. Yeah. And let's skip that page. Okay, so U.S. economy relative to the world market, we are fairly insulated from world markets, meaning that much of our trade is internal. On the top left, much of the trade is with Canada and Mexico. And net import, net export makes up a fairly small amount of our global GDP. And on the bottom, we're just talking about industrial production, industrial measurements, again, where we see it's sort of on the upturn. Let's do the next page. This is interesting, and we're going to spend a couple minutes here. I think this is very indicative of what we were talking about before. So the top left chart, household debt as a percentage of income. So you can see that the debt as a percentage of disposable income is low, and it's at its lowest point in a long time, which just means there's a larger portion of someone's wallet to spend on other stuff. And we like people in this country spending money on stuff, keeping the money flowing. And then on the right top, people are starting to take out more credit. So revolving credit is going up. And that's not a good thing long term for folks, but it definitely means there's a velocity of money. On the bottom left, non-farm payrolls continue to go up. And then on the bottom right, this is interesting. Hourly compensation goes up, but productivity is also going up. But compensation is not rising as much as productivity. So we're getting more productivity out of folks without having to pay them quite as much. So economically, that makes sense. May not make sense for the individual, but we're starting to get a better productivity per worker. So that's an important part of our economy. Let's go to the next page. For most folks, inflation can be an issue. And for those of us who remember inflation back in the 80s, it was disastrous for many. So we try and keep track of inflation. Where does it come from? Inflation, we think, is right around 1.7, or the CPI is around 1.7. Much of that comes from housing, if you look at the bottom left, which is fine. That's what people spend money on, but it's an important way to think about it in that there are many people where housing inflation has no impact because they already own their house or they don't have payments. And so inflation from other sources could impact people more, especially the medical care, but we're not seeing inflation come up in food and beverages, recreation, and things like that. So that's an important indicator. We know that the Fed's target is 2%, so that is one reason that the Fed could increase rates, is to try and push that inflation number a bit. Let's go to the next page. I talked a bit about housing. The top left chart, we see the new and existing home sales going up. That's a very volatile number. We see that up and down all over the place. And then on the far right, home ownership as a percentage, we think that's bottoming out. On the bottom left, the Housing Affordability Index is really taking the cost of a home versus how much does it cost to rent, and they create an index. And so we're getting at a point where housing is more affordable for most folks. And then on the bottom right, because interest rates are low, which is a good thing for folks taking out a mortgage, the average payment still remains fairly low. I'm going to end on this page and then turn it over to Elizabeth. Global outlook looks fine, looks good. We can see where the global economy is going. Our economy is probably fairly flat to up a couple percent. We continue to like developing economies, even though that takes on a bit of volatility. The bottom left chart is interesting because our economy has a levered effect on other economies. So the more we grow, the more that the international or the global economy can grow at about a 6 times rate versus the Chinese economy. So that's an important part. We obviously are a big part of the world economy, and people are looking at us. And so we believe our economy will grow 1 to 2%. However, it remains to be seen the impact of any sort of tax cuts or regulation relief, and that's something to look for as the year goes on, and the impact of that, are they retroactive, anything like that. So again, we believe the economy is on pretty good ground. Labor, housing, and interest rates are accommodative. At this point, I'm going to turn it over to my colleague Elizabeth Dooley, who Carmen said has been with Rockdale for a little bit longer than I have, so we've been working very well together, and she's going to talk about the equity markets and where we see the equity markets going for this year. Elizabeth?
Thank you, Ted. We're going to start off talking a little bit about what our expectations are for returns across the various asset classes. On the left-hand side, you have our equity returns, and you can see for this year we are looking for slightly higher returns for growth equities and more modest returns for dividend and income stocks. What you'll notice that we have a base case, which is the dark blue band, but then we have really a range of expectations, which is at the gray band around our base case. And really the point that we're trying to get across here is that there are a lot of policy decisions that have to be made that may or may not be a positive for growth equities. So for example, whether we see tax cuts this year, how meaningful they are, whether we see any regulatory relief, whether we see any fiscal spending, all of those things will determine whether or not we see the earnings expectations being met for growth companies. And the other point that we're making here is that if we don't see those earnings expectations being met, then we may see another year where we have more demand for dividend companies like we've seen over the last couple of years. We're a little bit more confident in our outlook for fixed income. As Ted mentioned earlier, we are looking for interest rates to continue to increase gradually. On the opportunistic income side, with that particular investment, we are not taking a lot of interest rate risk, so it's not very interest rate sensitive. We are taking credit risk, and our view there is that as long as the economy continues to recover and the risk of default remains low, that still remains an attractive asset class. So looking at the scorecard that we have for the equity markets, a lot of the factors that Ted just went through, they help to support our outlook for the equity markets going forward. The two key factors, though, really are corporate profitability and valuation. Our outlook for corporate profitability has improved, but as Ted also mentioned earlier, there is an assumption here that we see corporate tax cuts happen this year. And just to give everybody a little bit of perspective, for every 1% cut in corporate tax cuts, that adds somewhere between $1.20 and $1.30 to S&P earnings. So the question really becomes, do we see tax cuts for the full year, or do they get rolled into 2018? And then when we look at valuation, we're looking at the PE multiple. And we have seen the PE multiples continue to creep up, but we're not yet at the point where we would say the market looks overvalued. And then obviously the worries are whether or not we see some kind of a contagion or some kind of an unexpected event that could have a negative impact on investor confidence. The table at the bottom of this chart basically goes through different valuation measures for the S&P. And one of the challenges that we always face in talking to clients and advisors is this idea of focusing on the absolute level of the S&P or the Dow and the fact that we continue to hit record levels. Well, as investors, we should want the market to go up. And the question should really be whether or not we have the earnings there to support the higher stock prices. And you see that in the chart on the top right-hand side, which basically shows you year over year, S&P earnings have continued to grow. So even though the market has continued to appreciate, we are still seeing the earnings growth to support that. And what we show you with the comparison of the different valuation measures in the table at the bottom is that if you look at the latest reading for all of the different measures, you can see that we're actually pretty close to the 20-year average for all of these readings. We're not yet in the danger zone of it or any kind of bubble territory. This chart makes the point that we spend an awful lot of mental energy worrying about the politics and what's happening in Washington. But really what this chart is saying is that if you look back over the last 70 years and you look at what party controlled the presidency, the Senate, and the House, and for how many years, and how did the market perform during each of those different scenarios. And you can see that it has a lot less to do with who's in control, and it has more to do with whether or not policy decisions are being made in Washington and whether or not businesses and consumers have a reasonable degree of certainty and a reasonable degree of confidence. That's really what drives the market. It comes down to what's happening in the economy more so than who's in the White House and who has tweeted what. This table goes through how we come up with our forecast for the S&P and what our expectations are. On the left-hand side, you can see our 2017 earnings estimate for the S&P. We have a range between $132 and $136. That represents about a 7 to 10% increase in earnings over last year. And if you look at the numbers that are highlighted in green, we think a reasonable PE multiple is somewhere between about 16.5 and 18 times forward earnings. And then if you look at the S&P 500 index level at the bottom of the table, you can see based on a midpoint of $134, we're looking for an S&P index level of somewhere between about 2211 and 2412. And that represents about a 1 to 10% increase for the year based on where the S&P was at the end of last year. But we're already around the 2345 mark. And the point we're trying to make here is that we do believe the market has probably gotten a little ahead of itself, already pricing in that we will see all of those positive policy decisions made in a relatively short time frame, that we see tax cuts, that we see regulatory relief, that we see a government spending plan. So we're just a little bit cautious that we may see a little bit of volatility if there's any delay or if there's any uncertainty about the timing of all of those things. Then switching over to interest rates and the concern about higher interest rates. Usually when we talk about higher interest rates, it's regarded as a negative for equity investors. But what you have to keep in mind, and particularly this time around, is that we're not only starting off at extremely low interest rates, but we're looking at interest rates increasing gradually over time. And if you look back historically, you typically have to get to about a 4% yield on the 10-year Treasury before you're at the point where investors are not getting enough of a reward on the equity side for taking the additional risk of being in the equity markets. And at under 2.5% on the 10-year, we're still quite a bit away from that. So it's really the starting point and the pace of rate increases. Those are the things that we pay attention to. This chart, and I think most people have seen at least some variation of this, is just our reminder that short-term volatility is perfectly normal. This chart looks at the S&P 500 going back over the last 30-plus years. The blue bars represent the return for each calendar year, and the red boxes represent the largest decline during each of those years. And you can see every year without exception, we've had some kind of a negative experience, and some years it's been more negative than others. And even if you look over on the right-hand side, over the last 3 years, we've been down at least 10% at some point during the year. So if we were to see a pullback in the market or some kind of a price adjustment, that would be perfectly normal and not something to become overly concerned about. Then looking at opportunistic income, which is another area that we favor, all of the factors help to support this particular investment. And the thing to remember here with this investment is that we are willing to take a certain amount of credit risk in order to capture a higher yield. We're not willing to take a lot of interest rate risk because of our expectation of rates continuing to move higher. And really the key point here is the last bullet point under the highlights on the left-hand side. And basically what we're saying is that as long as default rates remain low, and we think that's a reasonable assumption given our economic outlook, and Ted just went over all of the reasons why we're pretty positive about the U.S. economy. So as long as the economic outlook is improving, company balance sheets and income statements are improving, the risk of default remains low. And as long as the risk of default remains low, we see this as an attractive asset class. And just to give a little bit of perspective on that, the chart at on the top of the page, the dark blue line shows default rates for U.S. high-yield corporates. And you see that they have continued to come down over the last year. And if you think back to one of the earlier slides that Ted went over, which basically looked at performance last year, high-yield bonds were one of the better performing asset classes, and it's for exactly that reason. As the outlook continued to improve, as the concern about risk of default decreased, we've continued to see those bond prices improve. And then putting it all together in terms of how we want to be positioned, if you follow the 5 black triangles, which basically go through all of the different asset classes and where we want to be positioned, you'll see that there are 2 that are right of neutral, and those are the 2 areas that we favor the most, and that's U.S. equities and opportunistic income. Within the U.S. equity space, we favor more the U.S. core and the dividend and income stocks. And for the U.S. core, the main reason is that we see continued earnings per share growth. Our expectation for earnings per share growth for this year in total is about 9%. About 4% of that increase, though, comes from expected tax cuts. So if we don't see the expected tax cuts, we're looking at earnings per share growth somewhere in the 5% range. In terms of how we want to be positioned within core equity, we continue to focus on high-quality, steady growth companies that are selling at reasonable prices. And some of the investment themes that we have include things like the stronger consumer, the digital revolution, the industrial leaders, and also companies that should benefit from continued improvement in the U.S. economy and that have more exposure to the U.S. consumer. And then on the high dividend and income side, again, it's focusing on companies that have very solid operating results, that have the cash flow to not only support their dividend payment today, but also the potential to grow that dividend over time. As I mentioned earlier when we talked about our expectations for returns, yes, we are paying attention to a higher interest rate environment and what that means for the dividend stocks. But as I mentioned earlier, we're still in the very early stages of interest rates starting to move higher. And then if we look at the dividend and earnings growth of the companies that we own, the mix of investments that we have, those companies have had a compounded growth of dividends of about 5% over the last 2 years, and they've grown their earnings over 7%. So, while the reliable cash flow is a focus, the ability to grow that cash flow over time is also a focus. Then on the international side, you can see we are underweighted international equities overall. We're more cautious on the developed markets, and really what we're talking about there includes both the Eurozone and Japan. And while it is true that some of the more recent data coming out of the Eurozone has been more positive, when we look at consumer confidence and business confidence, which are really the long-term drivers of growth, both of those indicators remain very weak relative to what we see here in the U.S. Then on the emerging market side, we favor Asia. We don't have a lot of Latin American exposure. And the reason that we favor Asia is that, that's where we see the greater wealth creation longer term. We see the Asian economies continuing to be one of the main drivers of global growth. One comment in terms of where our exposure is, we're focusing primarily on domestic consumption. We have little to no exposure to the exporters. So the comment that Ted made earlier about concerns about any kind of trade protectionism or changes to trade policy, we really don't have a lot of exposure there. Although as emerging market investors, we have to expect when there's any uncertainty, we are going to deal with a lot of uncertainty in this space as well. On the core fixed income side, we remain fairly cautious about putting new money into the bond market, and really the point we're making here is that we believe we're just at the early stages of interest rates starting to increase, so we continue to want to underweight our interest rate exposure, and that's primarily within the core fixed income. As I said earlier, we favor more the opportunistic income space, and really what this comes back to is the idea that as the economy continues to recover, that helps to support corporate earnings. That should in turn help to keep default rates low. And then on the high yield municipal bond side, the tax-exempt opportunistic income side, this is an area that we also favor, although we have to keep in mind that these investments are a little bit more interest rate sensitive. And then also, since the election, we have seen a little bit less of an appetite for municipal bonds in general, both on the investment grade side and on the high yield side. And a lot of that has to do with expectations of lower income tax rates, and then typically less demand for municipal bonds in that particular environment. And then finally, on the real asset side, we like real estate, primarily income generating real estate. We do not have a lot of commodity exposure, even though it is true since the election we've seen recovery in certain industrial commodities, but we think part of that recovery is due to an expectation that we'll see some of the global trade deals being renegotiated, which could be positive for some of the commodity producers. But really what it comes back to for us is that when we look at global supply, we still see excess capacity. And as long as there's excess capacity and global demand that's growing at a relatively slow pace, that's going to keep downward pressure on these prices. And then finally, TIPS are the Treasury inflation-protected securities. We're not overly concerned about inflation, so we're not paying for inflation protection. And I will say, historically, we have not necessarily been fans of TIPS, mainly because the fear of inflation is really what drives the prices, rather than the reality of where inflation actually ends up. So we tend to look at other businesses that can grow their earnings, grow their dividends in a stronger economy, in an inflationary environment, and we feel that that gives us much more protection.
Okay. Well, Elizabeth, thank you. Is there any other comments that you would like to add before we actually start our question and answer period?
No, I think, Carmen, we're ready to open it up for questions.
Okay, excellent. So if you could please look at your monitors, and it has an email there for any questions that you may have for either Ted or Elizabeth. You can send them to jivey@ebwllc.com, and we'll be more than happy to make sure that either Elizabeth or Ted answer the questions. So we'll give you a few minutes to actually send your emails to us. In the meantime, maybe I have a question here for either Elizabeth or Ted. But, you know, when I hear clients, clients are still, they still seem to be concerned that there's a correction looming in our near future. What are your opinions about that?
Well, when we talked about, you know, where the market is and how far we've run since the election versus where our earnings expectations are, we do think the market has probably run ahead of itself a little bit. And also when you take into consideration what are the sectors that have been driving that run up in the market. Some of the biggest gainers have been aerospace and defense, energy, financials, and that's all tied into expectations that these policy decisions are made quickly. So if there's any delay or any uncertainty, that could cause some short-term volatility. But you know, when we looked at that volatility chart, we made the point that down 10%, even down 15%, while it's painful to deal with in the short term, is all within our expectations. And it really comes back to not only whether we're seeing volatility in the market, but has anything changed in our economic outlook. And if our economic outlook is still solid, we're not going to overreact to that short-term volatility.
Okay, thank you. Thank you. And another question that I think it's also in one of the top questions that I hear a lot of my clients actually ask would be about inflation. You know, we see that inflation is predicted to go up. At what point in time, you know, is inflation good at a certain time, and when it gets to a certain level, when does it become not healthy?
Well, if you look back historically, the average inflation rate for the U.S. economy is somewhere in that 4 to 5% range, and we're currently running at around 2%. You know, we're still really at the stage where the pricing power is on the side of the buyer, not the seller, which is not necessarily healthy for an economy. So you need a certain amount of inflation, which is partly why the Fed has those inflation goals, and they're looking really at 4% inflation as being a sign of a healthier economy. And we're still a very long way away from that. And we would also add that if you look at the global economy, where global interest rates are, where global growth is, you know, it's hard to see significant inflation with relatively weak growth and historically low interest rates.
Okay. All right. Again, for any of you that may have questions, you have the email in front of you, and anybody else that has any questions, we would certainly welcome them. So when you're talking about industrial companies and areas that would be that would have a potential for growth, what type of industrial companies are you referring to there, Elizabeth?
Companies like Berkshire Hathaway, General Electric, some on the energy space, or some of the infrastructure companies. Areas that we should see a benefit, partly from continued recovery in the U.S. economy, and less exposure to the global economy. So for example, we don't necessarily own Caterpillar, and it's not that we don't believe Caterpillar will be a beneficiary if we see infrastructure spending, but when you look at Caterpillar's earnings and how much of their sales are generated outside of the U.S., they're a company that continued to be challenged by the stronger dollar. So it's more of a focus on industrial companies that benefit from recovery in the U.S. economy and have more U.S. consumers.
Mm-hmm. Okay. All right. Well, here we have our first question, and it's coming from one of our clients, and a question that they have, they said that this client is deeply concerned about political risk, both domestic and geopolitical. Trump has shown a remarkable degree of ignorance and even indifference to significant matters relating to international affairs. Can you address this in terms of how that would impact both our domestic and geopolitical, how that has an impact both short-term and long-term on our markets?
Sure, I can do that, and Elizabeth, you can chime in. So one thing that we worry about is consumer confidence and investor confidence, which is kind of what you're getting at. So when we see PEs in the market of 17 or 18, that connotes a confidence in the market that there will be growth. So we kind of take our cue from the markets, plus from companies, big companies like Apple and Exxon, that are moving forward in a positive direction, while we see on the news the daily disruption. Underneath it all, we are seeing our economy move forward, we're seeing business move forward, and we're seeing the markets move forward. So I think we just need to take a little bit of solace in that, where the broad, longer-ranging economic impact is moving in the right direction. I think if we were to see massive disruptions, especially on the trade side, that's when we would all start to get concerned that the administration really is just disrupting our economy. But for now, nothing really has happened. So there haven't been these tax breaks, there haven't been trade wars, nothing's going on, there's just a lot of talking. So we're sort of just all sitting back waiting to see what will actually happen. Elizabeth, would you agree with that?
I would agree, but I would also say, I mean, it is something that we have a similar concern about. But if you look back historically, and to Ted's point, as long as the economic outlook is still reasonably positive, and if you think about it for the average person, as long as you're reasonably confident you can keep your job, you're possibly seeing some wage increases, you're able to keep your home, your circle of friends are in a similar situation. While we talk an awful lot about what happens, until it actually has a direct impact, then we don't necessarily react to it with our investments. But we also have to remember that you never really know what it is that investors will become overly concerned with. And if you think back to the summer of 2011, why was the outlook for Greek debt such a worry to everybody? When you think about how much the Greek economy contributes to the global economy. So at the end of the day, it's a relatively small impact, but the stock market was down over 20% during that time period. So to Ted's point, we're confident, but we are always paying attention for those factors that could be that contagion, it could be that lightning bolt that causes some short-term volatility. But again, if our outlook is still positive, we're not going to overreact to that short-term anxiety.
Thank you, Elizabeth. Thank you. And listen, to the same person that gave that initial question, what are some of the downsides, let's say, for example, if there was a trade war? Can you speak to that, Elizabeth?
Well, if you think of it in very simple terms, if we start putting tariffs on goods that are imported from, say, China or Mexico, that will create higher prices and it will lead to higher inflation. So part of the reason that we've had such low inflation for the last couple of years is essentially we've been importing goods that cost less. And if that were to end and we had higher prices, so that would cause an inflation, it would have an impact on how much discretionary income consumers actually had. And then, you know, at the end of the day, their ability to spend and grow the economy, and also their ability to invest.
Okay. Well, thank you. Thank you for that. And I have another question. I'm not sure if it's more of a statement than a question here, but when you were talking about REITs and real estate opportunities, are you favoring more international real estate or U.S. real estate?
We have some international exposure, but it is primarily U.S. Most of the real estate exposure we have is within the high dividend and income category, and really our focus there is on the predictability of the cash flow. Now within the U.S. our exposure has changed over the years. You know, today we have more exposure to offices, less exposure to retail. We've always favored healthcare. You know, that's where we see very consistent cash flow.
Okay. Okay. Here's another question that I have. It says, it appears oil prices are steadily increasing. Is that correct? And would, let's see, is that good for oil companies or the consumer or both? The steady increase in oil prices.
We've seen an initial increase in oil prices, partly due to the expectation that OPEC will keep production steady. But just as we've seen those oil prices increase, we've seen production in the U.S. start to increase. And earlier this week, there were some headlines which expressed the concern that as production was increasing, that would cause prices to fall. We've been of the opinion since prices started to fall in 2014 that when you look globally, we still have a lot of excess capacity. And if you take the U.S. as an example, you know, there's a lot of wells that are already in place, but they're capped. But they can be brought back on board very quickly if they're financially viable. So we're of the opinion that we'll stay somewhere in this $45 to maybe $65 range, and that it will ebb and flow based on where production is.
Okay. Okay, thank you. I have this other question here, and I think that there's a lot of people that do have the sentiment. It says the long-term physical picture for the U.S. is downright scary. Few seem to talk about it anymore. Does it still matter?
It still matters, and yes, I would probably use a similar way to describe it. But really, the key driver of deficits longer term, it's still Social Security and Medicare. And so the question becomes, you know, given the fact that the Republicans have the majority, will we see any policy decisions made that might limit the growth going forward? We're not at all concerned for, you know, clients who are already, you know, using Medicare or collecting Social Security, but I think us younger people recognize that something has to be done longer term for both of those programs to remain viable. And you know what most people don't realize is that the income base, it increased fairly significantly this year. I think it went from, I think it's like 118,000 to 125,000. So you know, it really becomes a question of what will they do to kind of limit that growth in that deficit going forward.
Okay. Thank you. One other question that I have here in front of me, it says, we've heard a lot about the border adjustment tax. Can you explain this?
That's a type of tariff that they're talking about. So for the goods that are imported, there would be an additional tax that has to be paid. So that's what I was getting back to, with the point that if those additional taxes are applied, then you know, we're looking at potentially higher prices.
And that would be something that would certainly impact us as consumers here in the United States, obviously.
Correct.
And create inflation.
And create inflation. Okay. Well, that seems to be one of our last questions. I want to thank both you, Elizabeth, and Ted for participating in our 2017 Economic Outlook. We want to thank all our clients for attending our webinar, and we invite you that if there are certain subject matters that you would like us to address in future webinars, you send your advisors an email and request certain topics to be addressed in our webinar. Our next webinar is coming up in April, and we will be sending out emails certainly in the very short term, giving you the topic of our next webinar. So with this, I'm going to say thank you again for attending. Thank you again, Elizabeth and Ted, and we'll see you at our next webinar.
Thank you for including us.
Thank you.